When a multinational enterprise capitalizes a subsidiary, it chooses between two primary funding methods, equity or debt. Because interest is generally tax-deductible, debt often provides a highly tax-efficient method of finance. This creates an incentive for thin capitalization, a practice where a company is structured with a disproportionately high level of debt compared to its equity. By highly leveraging the subsidiary, the enterprise artificially increases its deductible interest expense. The result is a mechanical shifting of profits. The operating subsidiary claims massive interest deductions against its profits in a high-tax jurisdiction, while the related party lender receives that interest income in a jurisdiction that taxes it at a low rate or not at all. To counter this cross-border base erosion, the OECD introduced Action 4 of the Base Erosion and Profit Shifting, or BEPS, framework. Action 4 establishes a clear standard. It links an entity's allowable net interest deductions directly to its actual economic activity. That activity is measured by taxable earnings before interest, taxes, depreciation, and amortization, or EBITDA. The UAE has implemented this global standard directly into its corporate tax law. Article 30 introduces a general interest deduction limitation rule, and Article 31 applies a strict, specific interest limitation rule. Because these rules interact, evaluating a corporate capital structure requires building a precise decision matrix to separate legitimate commercial financing from artificial profit shifting. This flowchart represents our compliance matrix. We start at the very top by defining the entity's total interest expenditure pool as outlined in Articles 1 and 29. Under Ministerial Decision 126, interest is defined broadly. It extends well beyond standard commercial bank loans to include the profit components of Islamic financial instruments, the finance elements of non-finance leases, and capitalized interest amortized over time. It also sweeps in associated costs, like guarantee and arrangement fees, as well as foreign exchange gains or losses specifically tied to that interest. Once the total pool is defined, we hit our first filter, the safe harbor test. This test is based on net interest expenditure, which is simply the total interest expense incurred during the tax period, minus any taxable interest income derived in that same period. If the net interest expenditure is 12 million dirhams or less, the general limitation rules do not apply. The entire amount is fully deductible. This de minimis threshold serves a specific structural purpose. It removes the complex compliance burden of thin capitalization rules for startups and smaller businesses while they require unhindered access to capital for growth. However, if the net interest expenditure exceeds 12 million dirhams, the funds are routed to Article 30, the fixed ratio rule. Here, the maximum deductible interest is capped at the higher of two numbers, a flat 12 million dirhams or 30% of the entity's tax EBITDA. Tax EBITDA is a statutory figure that requires specific adjustments to ensure it reflects the entity's taxable economic capacity in the UAE. The calculation starts with the taxable income computed under Article 20, adding back standard depreciation and amortization expenditures. Next, we add back the net interest expenditure itself for the relevant period. Then we apply a critical subtraction, removing any exempt income identified under Article 22 from the running total. This prevents a company from using non-taxable revenue streams to artificially inflate its base borrowing capacity. Importantly, certain entities like banks and insurance providers rely on interest as their direct operating expenditure and are entirely exempt from this Article 30 calculation. There is also a temporal carve-out. Debt instruments with terms finalized prior to December 9, 2022 are exempt from this limitation. For everyone else, the fixed ratio rule mathematically forces an entity's borrowing power to remain proportionate to its taxable local economic output. But calculating the cap is only half the matrix. We must also evaluate the anti-abuse override established in Article 31. This rule triggers specifically when debt is obtained, directly or indirectly, from a related party. The restriction activates if that related party loan is used for 4 specific transactions: funding a dividend distribution, a share buyback, a return of capital, or capital contribution to another related party. These activities prevent circular funding loops, where money is passed back and forth simply to generate interest deductions without creating economic value. A taxpayer can defend against this by demonstrating the loan's main purpose was not to gain a corporate tax advantage. The law provides an objective standard for this defense. the taxpayer must prove the foreign-related party receiving the interest is subject to a corporate tax rate of at least 9%. If the expenditure fails these tests, we move to the consequence phase of our matrix. How the law treats denied interest depends entirely on which article denied it. General interest expenditure disallowed by the 30% cap under Article 30 is not permanently lost. It is carried forward and can be deducted over the subsequent 10 tax periods. In contrast, specific interest disallowed under the anti-abuse provisions of Article 31 is permanently denied. There is no carry forward available. One final caveat. If a company elects to use small business relief, it forfeits the right to carry forward unutilized interest from that period. Calculating total debt is no longer sufficient. Practitioners must rigidly classify the source and the purpose of every loan to avoid permanent base erosion penalties. Let's run a complex set of financials through our constructed matrix to see these mechanics in action. In this scenario, the entity has 70 million dirhams in general interest expenditure, 10 million in specific related party expenditure, and 30 million in interest income. The base accounting EBITDA is 100 million, but 20 million comes from exempt income. Step 1. Calculate tax EBITDA. We take the 100 million base and subtract the 20 million exempt income, resulting in an adjusted tax EBITDA of 80 million. Step 2. We apply the fixed ratio rule. 30% of our 80 million tax EBITDA gives a ceiling of 24 million. Step 3. The safe harbor check. Because 24 million exceeds the 12 million threshold, 24 million becomes the maximum allowable general deduction. Step 4. Calculate the net interest expenditure. Offsetting the 70 million in general expenses against 30 million in interest income yields a net expenditure of 40 million. Step 5. Apply the cap by comparing our 40 million net expenditure against our 24 million ceiling. The difference leaves 16 million of general interest disallowed under Article 30. This 16 million is routed to the 10-year carry-forward bucket, preserving it for future tax periods. Step 6. We evaluate the 10 million in specific related party expenditure. Because it funded a dividend and the entity has no tax advantage defense, Article 31 permanently disallows the entire 10 million. In the UAE, an optimal capital structure depends on aligning financing with Articles 30 and 31 to prevent permanent leaks in your tax efficiency.